All right, all right. Welcome back. Welcome back. My name is AB Ridgway. I'm the host of the Ridgway Report. I am your certified private wealth advisor, certified divorce financial analyst, tax professional admitted to practice in front of the IRS. I have my MBA in finances, so all those kind of fun things related to finances, all those kind of fun things that's up on the wall. Today we are going to do something special. We're going live here. Listen. I did a lot of recording, a lot of the good content on the channel. We've uploaded videos all the way up till about March or April. So you're guaranteed to get a week's worth, or every week up to about March 7th, I believe, or May 7th, excuse me, May 7th. You're going to get a new video on retirement, investment tips, investment calculations. I actually just finished recording about 2 more videos for you all. So the content's there. We're actually looking to produce a little bit more for you, a little bit more than once a week, but it just depends on, how these videos do. But I wanted to do something special today. I kind of wanted to do something live where you actually get to hear me speak. And the reason I brought this up was because my issue is that the way YouTube algorithm works, in general, it rewards kind of like copycats. So if something goes viral, someone reacts to it, then they get the attention from everybody trying to see what's viral, and then they kind of grow their channel. And the question I always ask myself is like, do I want to be popular, or do I want to be myself? Do I want to be authentic? I didn't establish this channel to be like everyone else. I didn't establish this channel to just copy what everybody else is doing because it's going to gain traction. What I really wanted to do was create a channel where there are people who are critical thinkers, and not necessarily those who are just easily distracted by what's new in the news, basically. Financial planning, as far as retirement is concerned, those things don't shift on a day-to-day basis unless there's some political risk, or there's a bill that's introduced, or things of that nature. But as a whole, as far as planning, this stuff has been as old as time, basically. So we really want to make sure that we are giving you the right information, because it's a very critical point in your life. You've worked 10, 20, 30 years. Now you're about to retire. You need to get on the ball. You need to make sure that the things you're doing are not going to be detrimental to your retirement, right? You're in all kind of different fields. The reason you're probably listening to this because you're not into finances. And you've heard horror stories, probably. I mean, these horror stories of people working 10, 20, 30 years, they roll over their 401k and they're hit with this huge tax bill, 37% on the highest tax bracket because they rolled over $2 million into their savings account to, feel like a millionaire, or whatever it may be, or that they have it in their account. And I want to help you avoid that, because if I can help you avoid a huge tax bill, even if it's from the 37 down to the 25% tax bracket, whatever it may be, that is saving you thousands of dollars that doesn't go into the government. It stays in your pocket. So that is my goal, is to educate my clients and educate you to say, all right, I feel confident of making this decision, or at least hiring somebody that can help me make this decision so I can save more money in the long run. The relief that you may get of just getting it off your table, like, oh, you know what? I don't have to deal with it. I'll just pay the tax bill. Let me move on with my life. That relief today can cause you so much pain and hardship in the future. And what I'm saying is that if you're stuck on your finances, if you're stuck trying to figure out all the documentation and paperwork, and it's just not your repertoire, it's just not, in your wheelhouse, then watch the channel, watch some videos, or personally reach out to me. I would love to work with you. But today I want to talk about the huge 401k tax bill that a majority of Americans are going to either face or they are avoiding, and it's causing them to lose a lot of money in their account. So let me kind of bring this up here. I just want to make sure that I'm on the same page. Here, bear with me here for a second here. I just want to make sure that if someone has a question, I'll be able to discuss that as well here. Okay. So if you do have a question, if you do come in here, you do have a question, feel free to put it into the chat. I'll love to kind of answer those questions as we go here. So the first thing is that we want to avoid this huge 401k tax bill. Now, let me be very clear. There's a difference between tax evasion and tax avoidance. So there's some very strong nuances, and I'm not going to get into all the details, but I'm going to let you know what you need to know. Tax evasion is illegal. You cannot do that. You cannot evade taxes, but you can create a plan and strategy to avoid taxes. So what we do on here is this is not tax advice, or let me put that disclosure. This is not tax advice or financial investment advice, but evasion and avoidance. To evade taxes, meaning that there is a tax implication, or you are subject to a tax implication and you don't want to pay it. You are evading. You get in trouble, or you did something wrong, you're getting in trouble and you're trying not to get in trouble for it. That's evasion. Avoidance is there is a potential tax implication if I do this transaction. I don't want to pay that tax. I want to do something different that may have a lower tax implication. That is 100% legal. And that's what we do. We figure out the tax code. We see your transaction and say, Mr. Client, if you do it this way, these may be your potential tax implications. If there is an alternative that is legal, and these are the statutes that support this, this is what you could possibly do in order to reduce your tax implication, right? That is tax avoidance. And today we are talking about tax avoidance in your 401k, which is really a big deal here, okay? So the first thing we really need to do is that, or even understand, is that 401ks are very unique to their employer, meaning that when employees are setting up their 401ks, there's a lot of different rules and regulations that they can pull from. The general aspect is the same, but the 401ks are customized for that company. Let me give you an example. One, all companies don't offer 401ks. That's the initial start. You may not have a 401k. You may have a 401k. If you don't know if you have a 401k or not, that's an issue. You need to talk to your plan administration or your human resources department to even determine if you have a 401k. Now, why would you not know? Sometimes in that big stack of onboarding papers, you're just so happy to get your job. You're not flipping through it to understand some of your employer benefits. That's a whole nother conversation. I have videos on that. I call those the non-monetary benefits of working. I mean, you can have a $50,000 job, $100,000 job, but if your job has $100,000 of benefits, that's almost a $200,000 job. Vice versa, somebody may be making, $150,000 with no benefits. So technically they're not making as much as somebody who may be making less, but have some of those benefits in place. Okay. So that's a whole nother conversation, but the plan administrator is going to determine if you're even eligible to be in your 401k, if it's offered. And the caveat I want to tell you is that some 401ks don't match in, contribution. So let's say that you put in $1, your employer may not match that dollar, or they may only match it up to a certain percentage. And there are some minimums and maximums we have to consider, for how much we can contribute to our 401k that are going to, the assets that are going to be tax deferred. So we have to understand those minimums and maximums, matching protocols, things of that nature, based on your salary. All that is going to be at the hands of your plan administrator. They're going to have that documentation. So as a financial advisor, I'll go through that document for you and say, all right, this is what you're entitled to. This is what their match is going to be. This is how you qualify. This is how much you can have at retirement. This is how much withdrawals you can have. This is the loan policy, and just really break down the intricate nature of these accounts, because they are very sensitive. And the reason they're sensitive is because the 401ks was actually established because pensions, to an extent, which is a defined benefit plan, meaning that at the end of your retirement, you were guaranteed a certain amount. Some pensions still exist. Some, they're actually fading away. This is what they call is self-directed, right? So this is almost like a profit sharing plan. The 401k is where you are going to be in control of your retirement. So the amount of money that you're contributing, the amount of money that you take out, the investments that you have is pretty much in your control. So what pensions happened was that people were working 10, 20 years. People were mismanaging those pensions, investing in things they shouldn't have, market crashes, timing, no guidance. And when you're ready to retire, you're thinking, oh, I'm gonna have this lump sum of money, and it's just not there, right? And that's the frustrating part for a lot of people. So the government said, hey, if we can have the 401k, you can kind of self-direct. This will be your money. You could take it whenever that you want to. You don't have to have the age limit where, you reach a certain age, you get X amount of dollars, things of that nature. Whatever is accumulated in that account at that point, you could take and take it to another job. And that's great. That was great for a long period of time. We've seen that. And what we're finding out too, because people are switching jobs so much, people have 401k spread out all over the place. I mean, some people have 3 or 4 different jobs they've been to, and they probably have $1,000 here, 2,000 there, 10,000 there, 15,000 there, and don't even know it. And one of the issues we kind of find out when we're dealing with clients is that, yes, they're ready to retire. And I asked them, well, where else did you work? And it's like, oh yeah, I used to work at X amount of things. It's like, well, did they have a 401k plan? He's like, I don't know. I just left. It's like, you go there and you find $50,000. You find $100,000. Like, you didn't know that? It's like, oh no, I didn't know they had it, or whatever it may be. Those companies don't care about you, right? So let's get back to the original topic here about the plan administration. So the plan administrator is going to have this document for you that's going to break all this stuff down, and we're going to figure out what it is. Now, you as an individual have to take some things into consideration. One is your age. Your age plays a very vital role in how you interact. I want to say interact with the 401k, because there's withdrawals, there's distributions, there's contributions, things of that nature. If you are under 55 years old, the likelihood that you're going to have to pay a penalty for taking money out early is very high. The reason is the 401k is actually designed as a retirement plan, not as a temporary savings plan that you could defer taxes so you could buy a luxury car and go on vacation. That's not what it was for. Many Americans were retiring with no money, and the government says we can't have this, because if people are retiring with no money, it puts a large stress on the economy, because the government needs now to step up and fulfill some of those funds, and then they're going to have to raise taxes. So it puts stress on the next generation, all those things. Like, hey, so if you are saving for your retirement, you're actually helping the economy, you're helping the next generation, which includes most likely your children and your children's children. So that's why it's important to do that. And that's why they have these rules. Now, if you're under the age of 55, right, you may find yourself with the penalty. Now, if you're disabled, or there's some other qualifications, that there may be some exceptions. But if you're 100% good health, you're fully employed and fully competent, most likely you're going to suffer that 10% penalty, right? Now, if you're 55 and over and you're with your current employer, there may be some things that you can do as far as an in-service rollover at that point. But once again, you have to leave, quit your job. There's a whole thing that comes with that. Then you have 59 and a half, right? Where supposedly you could just take your money out whenever that you want to. Just because you could take it out doesn't mean that's going to be tax-free. And that's what we find out. A lot of people are finding out. And that's where you get that huge tax bill, because they go, oh, this money's already been taxed. I've been working 10, 20 years. Oh, they take it out of my check. They tax it all the time. It's whatever. It's like, do you know that? Well, yeah. They already, do you know that? I didn't say what you assume. Do you know that? I don't. Yeah, you don't, right? So that's where the problems come in. 401k contributions are not, they're not post-tax, they're pre-tax. And that means that before it even hits, the money hits your check, it goes into this account. No taxes have been paid on it. I mean, there's a big myth out there that 401ks are double taxed. They're not double taxed. Sorry, as a financial advisor, it's kind of hard, but they're not double taxed. They're just not. Okay. So when it's time to take your withdrawals at 59 and a half, it's not tax free. So it's not like you've already taxed money and you just take the withdrawal. That's not how it happens. What happens is when you make that distribution, it's taxed at ordinary income, meaning that it can vary based on your individual income level in the year in which you took it out. So what that means is if you have no money and you take out $1,000 out of your 401k or whatever it is, you make a distribution. That income is only $1,000. It's below the threshold. You probably won't pay any taxes on it, right? But as you kind of have more income, whether you have Social Security or maybe you had sources from anything like an investment property, you start going up in a tax bracket, and it's going to base on your individual tax bracket on the amount that was received. Now, obviously, there's adjusted gross income and things that we can do on the tax side to help lower your tax implication, get you in those lower tax brackets so you pay less taxes. But that's a whole nother complicated subject. I'm just kind of keeping it very simple and saying your taxes is not as they are with brokerage accounts where you get 0, 15, 20%, depending on your income level. Once again, they're not what they call preferential rates. You're not going to get those rates on a 401k retirement because they're pre-tax. So it's ordinary income when they come in. Okay. So stay with me, hopefully. So these ages are very important to determine. Now, also, we're talking about required minimum distributions as well. Like when you start reaching your 70s, around that age, depending on your birthday, you may be required to take some money out if you're not employed, or maybe you are, you're currently employed. That's going to play a role of how those are going to incur and what amounts those are going to incur as well. So those are the things we need to consider, right? Your ages, right? If you're younger than 55, if you're at 59 and a half, if you've reached Social Security age, your distribution from your 401k could affect how much Social Security you're actually receiving. So if you have a large distribution, it could affect your Social Security. And that could be an issue too, right? You don't want to mess up money that you have guaranteed coming in because you're withdrawing too much money and things of that nature. Okay. And then plus your required minimum distribution. Once again, there's ways that we can kind of mitigate some of those issues. There's a thing called qualified charitable donations, QCDs, where you can actually, if you're charitably inclined or philanthropic, you can take the distribution from your IRA, give it to your charity, and they can write it off as a QCD so it doesn't look like income into your account. Now, once again, these are advanced strategies. I'm not telling you to go do these things, but I'm telling you there are ways that we can help avoid taxes on this huge 401k, and you can still live the life you want to. If you're, like I said, if you give a scholarship fund or an endowment scholarship and you're giving away $100,000, but you're like, I don't want to pay the taxes on $100,000 at 37%. So now I'm paying $3,700 goes to the government just to give $100,000. We have ways to get around that. Yeah. So we can keep $3,700 in your pocket, and then you can still give away your $100,000 endowment scholarship, or, be philanthropic to your church or charity of your choice. Okay. Also, we need to consider loans. Loans are going to be very important as well, because when we're younger, we're in this, what they call accumulation stage. And in the accumulation stage, what we do, we find out that a lot of people are accumulating debt. That's what they call it. Debt is accumulated because you're buying your house. No one has $500,000, $600,000 to pay cash for their house. So they go and get a loan. That's accumulating debt. Okay. They have a vehicle. Your vehicle is $60,000, $70,000, $80,000. You don't have that on hand in cash. So you go and get a loan. So you are building your family. You have a baby. You got to pay the hospital bills. Those things start to come up. So you start accumulating this debt, even though it may not be consumer debt like credit cards, but it could be that home, or that could be that house, things of that nature. So what we find out is that the average American is about $100,000 in debt, including their home. So that is something that we're going to have to deal with. But in extreme situations, if you don't have the cash on hand, you may go rely on your 401k. And that is one of the benefits of having your money in a 401k, is you can actually loan off that money while you're employed. Now, there may be some fees associated with it. You have to talk to your plan administrator. Once again, we need that packet so we can answer some of those questions. But typically what they do is do a payroll deduction. You're not paying it cash and they hope that you pay it back. They do it through payroll deduction. So they're getting their money, is going back into your 401k account, and it can kind of continue back to growing again. But you set up that idea. You set up that loan where you say, I'm going to pay back in five years. This is the interest, whatever it may be. You borrow that money. Now, it's not a taxable event because it's all staying within the company, staying within your 401k, is just a loan against your own money. But if you decide to leave, or you're retiring, you do it 2 years prior to pay off an RV or a car that you have. If you leave, you are going to be subject to the taxation of the balance. So if you go borrow, I think the maximum is like $50,000. Once again, you got to check with your administrator how much you can actually borrow off of your 401k, because sometimes it's 50% of the balance, or I think it's a maximum of 50,000, whichever is greater. But once again, we got to look at those details here. I don't want to quote anything that's wrong, but the idea here is still, if there's a balance, let's say $20,000, and you're ready to retire, if you leave and you roll those money over, you're going to be subject to that $20,000 issue. You're going to be subject to that the taxation on that $20,000, because technically money you have taken out of your 401k, and the government's going to want a portion because they have tax deferred or deferred taxes for 10, 20, 30 years, and they're going to want their piece of that pie. Okay. So that's going to be important. So when you're making that decision, you're going to have to determine if it's, what your age is, what the loan is, and that's all going to be determined by the plan administrator and the plan, the retirement plan that you have at your employer. Okay. So next we're kind of thinking about rolling your retirement over. Okay. So there's ways that you can make the withdrawal, or make that transition from there's a way that you can make the distribution or withdrawal from your 401k. I kind of don't want to say withdrawal, because withdrawal is going to assume that you're taking the money out. If you want to move the 401k money from your employer to an individual retirement account or into your own name, this is what we're going to talk about now, because there's 3 ways you can actually do it. There's a direct rollover, there's an indirect rollover, and then there's a cash out option. Now let's start at the indirect. The indirect means the money's at your employer. They're going to send you a check, and they're going to trust that you're going to take the money and put it over into a new individual retirement account, or AKA another another tax deferred account. The reason why there's not a lot of tax implication is because you're taking the account from one tax deferred account to another tax deferred account, which is the individual retirement account. But when you do an indirect rollover, it's not talking from your employer to the custodian or the 2 custodians. They're talking to you. That's the indirect part. It stops by you first. Now the government says, hey, you have a choice. You can go and deposit the remainder of the funds into that account, and that'll be fine. We won't tax you. You got 60 days to do it. If you go over 60 days, we're going to charge you. But if you take a portion of it, like I need $2,000-$3,000. If you take the $3,000, you roll the rest over into an IRA. That's fine. You could do that. That's not a problem. There's going to be a lot of documentation, some 1099s that you're going to receive, 5498s to make sure that they received it. 1099s to make sure there's a distribution or notify you there's a distribution, and then a 5498 from your receiving custodian to let you know that they received it. Now, those are tax forms. You don't have to worry about those, but you do have to worry about those. They will be sent to you. You need to notify your tax professional to know those documents went in, so we could figure out, we need to make sure that the distribution was made, and then also that it was also received, so you don't get taxed. Okay. Those documentation is going to be proof. So when we talk about proving transactions, those are the documentations that we use. If we don't get those, we need to reach out to your custodian to get those documentations. But you'll be taxed on the portion that you keep. That's an indirect. Now, a direct rollover is where it goes what they call a custodian to custodian transfer. That means your job is just going to send the money over to the custodian. Now, they may not send the check. They may, but most likely they're going to send you a check, and it's going to put your name. It's going to say FBO, and it's going to have the custodian's name. It's going to have FBO, your name. So it's going to be Charles Schwab, Vanguard, Fidelity, for the benefit of, and then your name, insert your name. So for me, it would be Charles Schwab for the benefit of AB Ridgeway. Okay. That check's going to come to me. It's not a withdrawal. It's just basically me taking the check, depositing it to where I want to, whether it's Vanguard or Charles Schwab or whatever it may be. Okay. Sometimes you can have them send it directly, like, hey, I don't want it. Can you send it to the custodian? Sometimes employers are like, no, we have to send you the check to make sure you have it and you do all the legwork, because they don't want to be responsible for mailing it to the wrong address or whatever it may be. Now, you do need to give them the information. Say, hey, who's the custodian? What's the account number that you've established? And we'll talk about that in a little bit here. What have you established? And, who do we need to make this check out to? Basically, the information on the check to make sure it's accurate. And the names have to be accurate. So if your name is William and you go by Bill, don't tell them to put Bill, because when you open that account and it says William, it's going to be a problem. And you're going to delay the distribution and getting those accounts over. And a lot of things could happen in the meantime. Okay. The last one is cashing out. And that's what a lot of people do. They cash out not knowing what cash out is. What they say is like, I want to move my 401k, send me a check. They send them a check, they take the check and they run out to their bank and they slap it on there, and they're happy to tell everybody they're a millionaire officially. They go, deposit this into my savings account, right? And you're like, okay. They do it, cashed out, and guess what? The following year, they get this huge tax bill saying you owe taxes on $2 million. You're like, what? How am I paying? How am I paying, $60,000, $70,000 in taxes? How's this happening? Well, because when you rolled over your 401k, that $2 million you had in there, yeah, we're gonna need our portion, and we're gonna need like right now. And that's where people get in trouble. So not only if you have $2 million, maybe you could pay it, but once again, that's a whole nother conversation. But what happens is some people take out their 401k and they don't have the money to pay the taxes. So they'll roll over $100,000, 120. They go buy that fancy car, $100,000. Now they have $20,000 left and they don't have enough to pay the taxes. And now they have this huge tax bill of $20,000, $30,000 they can't pay. And now you owe the IRS. So you just retired, you have no more money in your account, and you owe the IRS. Yeah, that is a horrible, horrible, horrible retirement gift. Okay. But that mistake can be avoided if we do direct to custodian to custodian transfer. So if we do a direct transfer, so cashing out is probably one of the worst things that you can do. Now you may be asking, Mr. Ridgway, what if I need some money? We talked about the indirect, that's one. But one of my recommendations is that you do a direct rollover. And then once it's in the retirement account, then you can establish what type of withdrawals you want to make based on your tax situation. So if you need, 1,000, 2,000 here, 5,000 a month or whatever it may be, you can establish it once it's over there. So you don't make the mistake of potentially being charged taxes on the whole lump sum that you have. Now, as we kind of keep going, we kind of go into opening the account. Now, this is going to be unique once again for every platform. Fidelity is going to be different than Vanguard. Vanguard is going to be different from Charles Schwab. Our custodian is Charles Schwab. So I know how to open up Charles Schwab. That's my that's my jam, right? But the type of account you open is very important too. You can't just go in there and say, I'm gonna open up an account. There are what they call taxable accounts, and there's like tax deferred accounts, which we talked about earlier. Well, another name for a taxable account could be a brokerage account, is a type of taxable account. Some people have stocks, bonds, mutual funds that they have, maybe some Bitcoin, and they go, hey, Mr. Ridgway, I'm going to retire. I'm going to move all this money into my brokerage account. And you're like, okay. You can move it over there, but there's going to be some tax implications. Like, what? No, I'm taking it from one account and I'm turning to this account. I'm not touching it. I'm going to move it over. And you're like, no, that's going to cause a taxable event because this is a taxable account. This is not a tax deferred account. And that's where you can get problems as well. So we say, already have an account. Can't you just put it in there and put them together? No, you have to keep separate money separate. Okay. That's why there's a difference between an IRA and a Roth IRA. Oh, I got a Roth IRA. Can I just put all my 401k money in a Roth? No. Because the Roth IRA is post-tax. So that money's already been taxed. If you keep it in there for 5 years, if you're 59 and a half, you're going to be able to get some of the withdraw those interests, the earnings, in there tax-free. Now, with the Roth IRA, obviously you can take out your contributions tax-free at any time, but the growth on those earnings, you have to wait the whole 5 years and 59 and a half. And there's a lot of rules around there. So definitely don't take this with a grain of salt. Now, when I'm talking about opening the account, we want to make sure we open up a tax deferred account. So we want a traditional IRA open, established with the account number, with your name, with the proper address, things of that nature, with a reliable custodian. You don't want to just go online and just pick anyone. You want to make sure that it's somebody that you can trust, somebody that you know and like. Now, for us, I may be Ridgway Wealth Management. We do the investment portion, but I am not the custodian. You don't send your money to me. You don't send me a check. I mean, you can send me the check, but I got to send it to the custodian. So the idea here is that when you are an investment firm, the person managing the assets or holding the asset has to be someone else. So it doesn't have a conflict of interest. It doesn't go in my bank or some type of bank that I have. It goes into the custodian's platform and they do all the managing there. Okay. So that's going to help you there. So you open the brokerage account there. You can open it through me. We open it, get it all taken care of, and then you could do the direct rollover so you know exactly where to go to. Okay. So we talked to the plan administrator. We figured out our ages, our loans, some of the tax implications with making this transfer. We decided we're going to do a direct rollover, move everything over. We've opened up an account in the IRA. We notified our plan administrator, says, hey, Mr. Administrator, this is where I want to take the money. This is where we're going to roll it over. Now, once again, don't do this. Don't do this. Don't do this. Don't roll into your savings. I talked about it a little bit earlier, but don't roll into your savings. Why? Because people take that check, they cash it, they put it into their savings account. Now, you may be saying, well, you just pay the taxes and you'll be done with it. that's not the only thing that you lose. It's not just about taxes. One, if you're under 59 and a half, that's the penalty, right? So penalty plus the high taxes, that's 47%. Not only that, it's in cash now. And what we find out is that when it's in cash, like your savings account, you're getting pennies on a dollar. Look at your interest rate that you're gaining your savings. What, point zero something? And then even if you are making one or two in a high yield savings account, that's still only pennies for your retirement. And I get this. Like I said before, Mr. Ridgway, I was making so much money in my 401k. Now I'm making like zero. And you're like, well, yeah. When 401ks move the money over, they're just moving over the money. They're not moving over investments. So all the stocks and bonds that you had in there and mutual funds, they sell it. They send you a check. They don't send you the investments. So when the money comes over into the account, it needs to be reinvested. You would be surprised of how many people I see that they have hundreds, 200, $500,000 sitting in the IRA in cash. And what happens, what's so confusing is that they're making more money than they're making in their savings account, because they're in probably a money market, which is probably has what they call cash and cash equivalents. They're making a little bit more than what's in their savings account. So they're thinking that their investments are actually doing something, or they're beating the market. And that's one of the biggest cognitive dissonances I've seen. People like, I'm doing better than the market. The market's down by 10%, and I haven't lost a penny. I'm like, you're not invested in anything. You're not in the game. You know what I mean? It's almost like saying like, oh yeah, I've been playing basketball for 4 quarters. I don't have a foul yet. You're sitting on the bench. Like you're not playing. You know what I mean? So that's what we need to do. We need to make sure that the money that's over there is actually being invested, and then also invested on your risk tolerance. So one, if it's in the savings, it's not growing. So you don't get any compound growth. You're not making any contributions to it. There's a lot of things as far as that is concerned, but it's going to be hard to beat inflation as well in a savings account, because none of the savings accounts are paying that difference. So we see that as well. So we see that, right? So put it in there, put it into your savings account can be a big issue for rolling it over. Now, once you get the plan administrator, roll it over, open the account, roll it in, and then you get your investments, you got to understand about risk tolerance and risk capacity. So now you have a couple of $1 million in your individual retirement account, and you got to figure out what to do with it, because in the 401k, you just kind of pick, I want this one, conservative, moderate, aggressive, and just call it a day, right? Here in the IRA, you have more responsibility as far as balancing and choosing what you want. As a Christian financial advisor, I like dealing with companies that align with my faith and align with what I am trying to do as an investor and as a person. So if I figure if I'm not going to spend the money somewhere, if I'm not going to spend the money supporting tobacco or supporting this or whatever it may be, or this alcohol company or whatever, then why would I invest and make money off of people who do? And that's what we do here, is we make sure that the assets that we're investing in align with our beliefs, our ethics, and our morals and things of that nature. Now, what you do in your own personal life is yours. And like I said, that's what's the customizable part of it is. But in the IRA, you get more flexibility. In your job, it's like you pick these investments and that's what it is. But when you have your IRA, you could take more responsibility and have more control of what you're putting in there. So, but once again, like I said, we're almost at over the half hour mark here. But you don't want to do that into your savings account. It can cause a lot of different issues. Now, once again, the 401k seems very simple on paper, but retirement is very complex. There's a lot of different moving parts. So when I try to make the videos very simple, easy to understand, 5-6 minutes, maybe a part or two. But as you see here, this is 30 minutes in, and I've talked about so many different things that probably could be their own video, right? These topics in themselves could be 20, 30 minutes a piece, trying to break down what all these moving parts are. But as a financial advisor, I know those parts and can actually help get you through, because what happens is people just give up. They'll go, man, this is tough. I can't do this no more. Like, you know what? Just leave it there, right? And leaving it there sounds good. It sounds really well. I'm just going to leave it there, and it's going to do what it's supposed to do. It's not. because think about it. Let's say your company goes over. Now you got to track down your 401k. Let's say you want a distribution. How long is it going to take to get a distribution? Because now you got to go through the plan administrator. You still got to make that same choice if it's direct, indirect, rollover, cash out. And also, you're not watching it. You're not an employee anymore. That there's a reason why they call them employee benefits. You're not an employee. Your management fees, your plan administration fees, your job used to absorb those fees. They're not doing that anymore. So you're probably paying higher fees, or at least some type of management fee that's in there, and you're not getting any type of management. You're not getting any type of advice. Nobody is helping you with it. And then if you ever need a distribution, you got to go back and try not to make a mistake again. Dude, that is not what people thought about as retirement. And then also every year that you wait, your cognitive ability is almost declining to a point sometimes. As we age, we're not as strong as we used to. We're not as enthusiastic as we used to. There's things that we just don't want to deal with, and it doesn't get easier, it just gets harder. So now we fall victim to people taking advantage of us, things of that nature. So being able to take care of this early and having a plan can actually save you thousands and thousands and thousands of dollars in the future, and help avoid some of the huge 401k tax bills when you retire. Because when you retire, you want to be happy. You're like, hey, I'm done working. I'm in this third phase of my life, and I want to do this in the way that I feel comfortable. I don't want to have to keep worrying about my money, or if I rolled it over properly, or if it's being managed by somebody. It's like, I don't have to do that. Oh, you're going to do that. Oh, you're going to review my plan administration. Oh, you're going to figure out if I have any loans or not. Oh, we're going to figure out if it should be a direct or indirect rollover. Oh, you're going to help me open up the brokerage account. Oh, you're going to roll. Like, dude, that is the beauty of having somebody do all the legwork for you, and knowing that you're going to do it the way that you've intended it to do. That aligns with who you are, what you are, and what you want to be. And that's the beauty of what we do. Okay. So this live is what, 36 minutes? I think that's pretty decent, right? Talking about that. We'll talk about some more stuff, but definitely, if you're not subscribed to the channel, man, subscribe to the channel, because we're going to talk about 401ks, retirement, and not just the nuts and bolts, kind of like we kind of talked about today. This is a very, 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 very high level. High level. This is not even scratching the surface of the things we need to discuss, but there's hundreds of different types of 401ks, hundreds of different types of investors like you, and we need to figure out where you are, because if you're at 55, it's different than if you're 59 and a half or 70. All those different ages are going to play a role in how we are going to determine an outcome. They're going to change the variable. We have to make sure that we're focused. We have to make sure that we're making the decision that's right for you and right for your family. Okay. So make sure that you subscribe, like, comment, all that kind of fun stuff. I'm gonna try to come on here for some more insight, so I could be me, authentically me. I like the videos, and maybe y'all like the videos as well, but I really like coming on here and just really talking and being authentic to myself, being able to tell you how I feel, and not have to worry about hooks and talking points and closes. And I just it's just but anyway, that's me venting. Maybe I need to get a YouTube advisor to kind of do some of the legwork for me. Hold on a second. If there's something that you're interested in, or something that you need some more help with, definitely leave the comments below the video, or any one of my videos. Go check those out. As I said before, we're going to have videos coming in every week until May 7th. And beyond, but at least once a week, even in as early as January. So you'll see those coming out, and then we'll try to put in more in between time, just to get a feel about what you like, and listen to the audience. If there's any questions, let me know. But that's it for me. My name is AB Ridgway, and this has been another